Right, with Trump's tariff flip-flopping finally being put on pause for the time being at least, markets are going through an absolute roller coaster of emotions, and so are we probably. And the price swings we're seeing across the world in different markets is absolutely unprecedented. At the same time, I wanted to take a look at the most dominant tech stocks on the planet, the so-called Magnificent Seven from the US, as they are also currently being revalued. Not necessarily undervalued, but definitely repriced from their previous all-time highs. So the question is, which one is actually a good buy right now? And that's why in this video, I want to go through each of the seven, look at key valuation metrics like PE ratio, and I'm also going to share with you which one I'm personally buying and which one I'm definitely staying far away from. But let's start with a quick recap of what the Magnificent Seven actually are. Basically, it's a nickname given to the 7 US tech giants that have led the market over the last few years. And you see all of them over here, starting with Apple, Microsoft, Nvidia, Amazon, Alphabet, Meta, and well, 7th is actually not Berkshire Hathaway, but Tesla is considered the 7th one there as well. So these are the 7 companies that we refer to when we talk about the Magnificent Seven. Together, those companies make up well over 25% of the S&P 500. These are global powerhouses, not just American tech companies. Their influence stretches from AI to cloud computing to electric vehicles and digital advertising. But of course, they've also felt the recent hit in the market, and some of them have really taken a major repricing, and I think that's where great opportunities lies. So we're currently in a very interesting spot, right? Because the rate cuts, which have been promised, probably are being delayed even further, even though President Trump would like them to come sooner than later. Inflation doesn't really seem to be dropping as fast as people were hoping, and those tariffs, they're doing actually the exact opposite. And in terms of geopolitics, from tariffs to tensions, are adding yet another layer of complexity and risk. So many investors are moving away from hype to fundamentals, and that's why I think it's a great time to reassess the value Magnificent Seven are offering. Let's go company by company, run through the numbers. I'll share with you my personal take, and we can already see the effect of the tariffs had on those companies' valuation metrics, right? Here we see the PE ratios of the Magnificent Seven and how it changed from end of last year to where it is today. This is the 4th of April. So since then, obviously, it might have readjusted a little bit, but you can already see the light blue was last year and the dark blue is what it's currently. And some of them have been really valued massively. For example, Tesla, right? It used to have a PE ratio of 198, which is absolutely outrageous, I think. It's now come to 217, which is still astronomical in many regards. When you look, for example, a company like Google, which currently has one of the cheapest PE ratios out there at only 18. So that's actually really, really attractive. It was already low before, 24. It came down even further to 18. I mean, that's really, really attractively priced right now when you purely go off the PE ratio. And then some of the other big players as well really came down, right? I'm personally invested in Amazon. It dropped from 40 to 31. Even Nvidia, only a few months ago, when it was soaring like crazy, was at 53. Still way less than Tesla. And now it's also in line with some of the other ones at 32. So you can see immediate impact of those valuations coming down, which I think for investors is probably a good thing. Obviously, none of the things I'm talking about today is investment advice. I'm just sharing with you my thoughts, my opinion. Ultimately, your money, your decisions. So let's kick things off with Apple, which is now once again the most valuable company in the world, not just in the US, but in the world, even though a few days ago Microsoft was. So they're kind of trading places, but Apple has definitely been for the longest of time now the most valuable company in the world. Right, so in terms of price development, we can see here comparing it to the S&P 500, we're now on year to date, it dropped by 10%, while Apple is actually down 20%. That's a major correction over there. Of course, if we zoom out further on a 5-year scale, still we'll see obviously Apple outperforming the S&P, up 197% versus 82% of the S&P. So on the longer term horizon, of course, it has performed extremely well, but now with those tariffs in place, if they were to be enforced, and especially with Apple producing so many things over in China, that would make the iPhone and other things so much more expensive. If, as Trump suggests, ideally to produce them in the US, it just wouldn't make financial sense for people to buy that anymore. So obviously, a lot of investors are pricing that in. And we still see the valuation being an F. Most commonly, people look at the PE ratio, which now is around 28.5 compared to the sector medium of 20. Now, again, obviously depends on who we compare to, right? If I go to peers over here, they include in peers, Xiaomi, Dell, Fujifilm. Now, I really can't consider them direct peers because it's quite different product offering, service offering. So it's not really fair to compare them based on that. Hence, the valuation is, comparatively worse than those others, but I think you can't really compare them. But yeah, obviously, if you compare it to a 5-year average of Apple itself, comparing Apple to Apple 5 years ago, that's basically a good comparison, Apple to Apple, and you see it basically flatline, which is a good thing. Now, a lot of analysts are still putting Apple on a hold right now, which I would probably also see that way, because it really depends on how those tariffs play out, right? If they were here to stay, again, that will really hit them quite hard, I would say. If they were to be removed, I think we could see a little bit of price increase in there. But yeah, right now, I would also probably kind of sit on the sidelines and wait and see, because fundamentally, it's still a strong company. It's the most valuable company, so I don't expect them to 10x in the next few years. But I think it still has room to grow. But would I rush into buying the stock right now? Probably not. Apple's strongest part is the ecosystem, right? I've been also using Apple phones and MacBooks for the longest of times. And once you're in the system, you kind of stick with it. Even if prices were to increase a little bit, you would still kind of absorb it and go for the new device, because overall it just works so seamlessly together. However, at the same time, I'm really worried for slowing in innovation. I mean, look at what Apple came out with in recent times. Honestly, quite disappointing. I mean, I love to upgrade my phone every single year. This year's iPhone for me just wasn't enough to upgrade. The same when I look at AI, right? They promised all these AI tools, but actually, I mean, I have now the latest AI thing from Apple on the phone. Honestly, I hardly ever use it. Siri is still absolutely useless in my opinion. I mean, it plays and stops the song, but that's about it. For AI, I go to all the other tools, and it seems that Apple pushed it to even end of next year to come up with their own AI things and so forth. So honestly, overall, the innovation is really lacking in my eyes in terms of hardware and software. It's just minor iterations. And of course, the China risk, right? Because the only tariffs that are staying in place right now is on China from the US. So these tensions are really not helping Apple, who is producing a lot of their phones in China right now. So overall, I think it's a great company. Certainly not the cheapest, and not one that I'll be actively investing in at this stage. Moving on to the next company, which is Microsoft. Currently a similar PE ratio of 29.6. So definitely it also came down quite a bit. But what I really like about Microsoft is their continuous growth of revenue year after year after year. I mean, they have been just adding new income streams, new sectors, and they just really turned around a very boring company in my eyes to become, a major player in the tech space. Recently, they were once again the most valuable company in the world when Apple actually tanked quite a bit. And you see here, if we compare Microsoft with the market, well, they're pretty much down by the similar amount. But of course, also on the longer time horizon over 5 years, you see Microsoft outperforming the S&P 500. And I think Microsoft really has some really good things going for it. Obviously, they're very strong margins over there. They're sitting on quite a lot of cash generating services. They're also very strong, of course, in their cloud services, the Azure program, which they have. We see here the gross operating margin percentage of 69%, which is absolutely incredible. And of course, the deal they have with OpenAI, which really makes them one of the top players in the AI race. And well, we'll see how that plays out long term. But I'm really excited for Microsoft, how they turned the company around, and definitely more attractive, at least in my eyes, and better prepared for the future than Apple is right now. So definitely, I think it's still a bit pricey, but definitely a very solid long-term hold. And on top, one of the few tech companies that actually pays you also dividend. Yes, it's very small at 0.85%, but hey, they have been growing it for the last 5 years at an average rate of 10.25% as well, and growing it for the last 20 years. So for dividend investors who want to have a bit of tech exposure, that might be one to look at as well. Next up, we move to Amazon. I made a whole video reviewing this company in detail. I'll link to it at the end of this video. You can check it out afterwards, because that's actually been the first individual company that I added to my portfolio since quite a while. I went all in on ETF investing, but that was one of the few companies where I really saw a lot of potential. Now, yes, the PE is slightly higher than we've seen with the previous two companies, but still fairly reasonable, at least in my eyes. And I can't really compare it to competitors because, I don't think there is really any real competitor to Amazon as such. And when I look at the 5-year PE ratio development over time, it used to be, almost 73. Now it's half of that. So in my eyes, it's definitely better valued now than it used to be in the past. And same story here. We really see nice revenue growth year after year, quarter after quarter. And that's what I'm investing for, right? I want to have a company that grows the revenues and, of course, is very profitable, which is the case over here. You can see Seeking Alpha is giving it an A+, because the profit margins at almost 50% is definitely very much healthy. And I agree, despite the tariffs, I'm really confident that Amazon will do well, because they don't only rely on e-commerce. Obviously, it's a huge part of them, but they have so many other business avenues and ventures. Take AWS, that still dominates cloud business, right? Also, the huge investments into AI with Claude, as well as Amazon Nova, their own AI version, which is coming up, and they're really starting to roll this out more and more. And even the satellite business, which will be competing with Starlink in the future, I think it's going to be a substantial revenue boost for them going forward. And as you can see over here, I have been already adding to my Amazon position not so long ago. I started it recently. I went in at 214 and then kind of dollar cost averaged my way down. The last buy at $176. So I'm really happy with that. I've been really getting a very good low average price. Sometimes we buy higher, sometimes we buy lower. That's the whole point of dollar cost averaging over time, to get a good average price, maximize your returns long term. Well, next up, we come arguably to the cheapest and most attractively priced right now of the whole lot, which is Google or Alphabet. You can see their PE ratio really came down from an already low point to what it is now. So here we have the current PE forward ratio of less than 18. Definitely the most attractively priced Magnificent 7 stocks out there. And the overall business and revenue growth is still really impressive, right? I mean, look at the revenue projections, the revenue in the past. I mean, really steady, continuous growth over time. Once again, also very profitable. Look at their gross profit margins of almost 60%. So really, really outstanding. Most of the ratings giving it a hold right now. Seeking Alpha analysts actually giving it a buy, and Wall Street analysts are also giving it a buy. In fact, now their valuation is less than the average S&P 500 valuation, which is quite crazy, as one of the analysts mentions over here. And the advertising business, which a lot of people were afraid of, given the emergence of AI, is going to disappear. Well, it hasn't, right? We still see revenues growing, and they are adapting to it and embracing it actually. For run ads, they also use AI to optimize reach and effectiveness, therefore growing still their advertising revenue. And for the longest of time, I was really quite disappointed with Google's approach to AI. Same like Apple, actually slightly better, but pretty disappointing. But now that they came out with Gemini and they have all these different models, 2.5 Pro is actually really cool. You can use it for free. Deep Research, I use it so much. It's free of charge. I don't know how they pay for it right now, but it's really, really good. Definitely check it out. I really recommend it. And honestly, they're catching up quite quickly in the AI game, I would say. Also, Google Search becomes more and more AI driven. When you now look for something, you will always get the first part, AI summary. So I think they're really taking it serious and catching up with that, because that was my biggest concern. If search was going away, as more people use AI to search for something, right? Eventually, if Google can bring them back to Gemini, they can still use the influence of search. And then obviously they still at the back end have the strong cloud business, they have YouTube. And honestly right now, after Amazon, which I already opened a position, I'm really looking at Google to potentially open a position in the near future, because with their current valuation drop, I really think they're poised to see a major repricing to the upside going forward, because they're really putting now the seeds to grow in the future. I still don't think they have caught up to the likes of ChatGPT and some other big AI players. But the more they invest resources into this, I think they really have what it takes to catch up and take dominant market share of AI and some other businesses like cloud and so forth. So I think as an investor, given the current low valuations, you could potentially capitalize on that. With this, we move to Meta or Facebook with a PE ratio of 23. So it definitely came down quite a bit. And it's really interesting. A lot of people have written off Facebook a while ago when they rebranded to Meta and they said metaverse is the next future. But at this stage, it didn't really turn out to be the future, right? Now it really shifted back into AI, and they're trying to catch up with other leaders in the AI space. And they also just came out with a new model. And you can see how Facebook really rolls it out across the entire suite of product offering, from WhatsApp to Instagram, Facebook. You all see that little blue icon is their version of AI. So they really want to make it native throughout the ecosystem. So it's really ingrained with all the touch points that use Meta for. And what can I say? Revenues are not lying. They've really been growing year after year, and really kudos to them. I mean, their profit margins are just absolutely unheard of. Almost 82% is unbelievable. So they're very profitable, and they're obviously using that money to reinvest. And I also like that they're quite diversified. You can see here where their revenues come from. Really nicely balanced, right? It's not just one single place, because some of those big companies, they really rely on one or two regions. Here, it's really spread out nicely across the world, which I like, right? So even if one region was to go down, they can maybe offset it elsewhere. So that's always something you want to see. Looking at the CEO, he used to be really disliked by a lot of people, but he really went through a whole transformation and became like the cool guy, right? He kind of completely rebranded himself and the company. I think it was a good thing. And even now, you may or may not like him, but you have to give him credit that he really turned the company around, made it more relevant. And I mean, honestly, kudos to him. They're also really cutting down the operations. They're becoming more and more lean, outsourcing a lot of things to AI. That's why you see those crazy profit margins. Now, honestly, looking at all these metrics and what they're planning ahead, I think you're really getting a steal over here with Meta right now. Personally, still, I'm not investing in it because it's just not an industry I'm super excited about, because I feel right now the AI complements the existing services. And while I do use them, personally, I don't really use Facebook much myself, Instagram just a little bit, and WhatsApp just to communicate with a couple of friends or call back home once in a while. So I'm not really an avid user of their products, nor do I advertise on them. So for me personally, while I appreciate what the company is doing and their profitability and lean operation, I just don't personally get too excited investing in that company, and I don't see myself investing in it any time. But objectively speaking and looking at the company, I think right now is actually a good time to open a position if you wanted to start investing into Meta. And lastly, let's look at Tesla, which is currently down by 32%. And while I do think they really pioneered, EV cars in the past, and they've really done some really cool things with it, and obviously pushing that self-driving agenda, I mean, there's no denying that having a CEO leading the company who's so outspoken, so political, is just not helping them, right? I think they would be doing way better if he wasn't that, politically active, even though it seems now he's kind of removing himself or was being asked to leave the White House. We don't really know, but still very outspoken. And with one single tweet from him, he can really move the company in either direction. And that's not just something I feel comfortable with. I want to invest in a fundamentally strong company, not just one that is kind of emotionally driven based on their CEO's mood and tweets. And on top of all those political things, and a lot of countries now boycotting buying Tesla because what their CEO stands for, leave that alone. The fact that BYD from China is also absolutely leaving Tesla in the dust. You can see how they were way behind back in 2020, 2021, and 2022 was the first time they outsold Tesla, and since then have increased their growth dramatically, while Tesla actually started dropping their sales. And that's really worrying. And honestly, when you look at those BYD cars from China, for me, they look way slicker than any Tesla. In the past, when Tesla came out, I was really excited. I thought, I want to get a Tesla one day. But right now, I mean, I'm not saying I want to get a BYD. I prefer a Porsche or BMW or whatever, some German cars, right? Being a German myself. But be it as it may, a lot of people, they like those cars more. Plus the fact that they're not affiliated with Elon Musk. And most importantly, they're significantly cheaper than any Tesla has ever been, right? So a lot of people, obviously, they go for quality and price. And here, I think BYD is absolutely giving them a run for their money. And that reflects in those numbers over here. So I can confidently say that Tesla is certainly my least favorite stock out of all the Magnificent Seven. And with all that, they still have a PE ratio of over 100 at currently around 105, which is absolutely crazy in my eyes. Totally overvalued and unjustified. Together with the over-reliance on one person and the shift of sentiment, definitely makes this way too risky for me to invest any of my money into it. And if you want to dive even deeper into any of the names of stock we spoke about, or just nerd out about investing in general, then definitely check out the Smart Money Club. It's totally free to join. It's a place where we hang out with like-minded people, talking about all things personal finance, money, and investing. And also do let me know in the comments which of those companies we spoke about today would you be buying potentially right now, and which of those do you think is most overhyped. Next up, check out this video over here where I'm going to run you through why I decided to add Amazon to my investment portfolio. As always, thanks for watching, stay healthy, get wealthy, and I'll see you in the next one. Ciao.